Okay, so let's talk about the big changes after the autumn statement. So for the sake of all financial planners, accountants, tax advisors, we're going to throw out and ignore the back and forth. The previous government said the change about the last change, which was then changed again. But in this video, I thought I'd try and distill the key points, a bit of lighter on the edit as well so I can get this out in a short space of time. But I want to say first, this channel is not set up and is never intends to weigh in on any sort of political commentary on... It is always intended to just be a financial education channel, but it's just to let you know a few things which I think are going to potentially affect your pockets now and in the years to come. And I'm going to be highlighting what I think is going to make the biggest impact. And on this one, there were so many rumours flying around. Will they remove the capital gains tax exemption on principal primary residence on your main residence? Will they change pension tax relief? Abolish this, abolish that? Honestly, the rumour mill was flying around all the time on this. And the sort of cynic in me was thinking, look, are they just putting out every sort of rumour possible so whatever they actually say won't be as bad as all the combined rumours? Anyway, look, enough cynicism. So going into the autumn budget statement, we learned from the Office of Budget Responsibility data that interest spending has gone through the roof. This is generally bad for government debt. High cost of borrowing means anything we borrow now as a government is more expensive to us. This makes it much harder to reduce that debt and also to grow our way out. But by the end of this video, I will have given you a few key things that you need to know and also what I think you need to focus on to make the best of what could be, let's be honest, a challenging few years for your finances. So I'm going to go over the cuts, but I would say personally, don't get distracted by the immediacy of the cuts. This is all about the big freeze of fiscal drag. And what do I mean by that? Well, of course, I just mean the fact that so many tax bands are planned now to freeze for quite some time. The personal allowance of $12,570 frozen to 2028, the basic rate of $50,270 frozen until 2028. I think people really underestimate the impact of this. But when I frame it in context of inflation, you can see how massive this can be. So the Office of Budget Responsibility's inflation data says it's likely to be about 9.1% this year and 7.4% next. So that's over 17% compounded if you take it from the 2 years prior. And the tax bands aren't expected to increase until 2028 in a lot of cases. So let's just show you a really simple example. Let's imagine someone who's paying just at the threshold of basic rate, but they now achieve a 70% growth in wages. Now, I know wages don't grow in line with inflation immediately, and they probably won't at the moment, but over time they tend to. But anyway, this is the impact of the tax burden by that freeze. In fact, the data is that the tax burden by the mid-2020s is 4% of GDP higher than pre-pandemic levels, and it's projected to be at the highest sustained level for about 7 decades. And if we look at this information from the Institute of Fiscal Studies, taxes are set to rise for pretty much all earners by 2027-2028. So one of the big headline grabbers was capital gains tax. So this one is quite a big one. The capital gains reforms are expected to raise about £440 million a year by 2027-28. And this is quite a raid on people's wealth if you do potentially have capital gains tax to pay. So a capital gain generally is just tax payable when you sell certain assets and you see a gain of their value. There are some things that are exempt entirely, but for the purpose of this video, I'm just not going to go into that or the calculations. But currently each individual gets an allowance of £12,300 per year. That's the gain that you can make without paying further tax. The key thing is it isn't limited by the income you earn either, so you could potentially earn say £150,000 on income and still have your full capital gains tax allowance. However, that's unlike income tax where your personal allowance is tapered down if you earn over £100,000. And there are often quite good planning opportunities to transfer assets between spouses to make the most of both allowances. Anyway, that allowance from next year is going to get sliced to £6,000 and then down to £3,000 from 2024. So that's quite a hit. And basically how it works is that if you are above your exemption, if you're at basic rate when they add it on top of your income, it's 10% on any gain in the basic rate or 20% in higher. So it's still better than, for example, higher rate income tax, which is 40% or additional rate of 45%. So capital gains still arguably gets an easier time. But don't forget, those who have additional property, like a buy-to-let individually owned, pay an 8% surcharge on the sale, which means that a basic rate for them is at 18% or a higher rate at 28%. So what does this mean? Well, basically, look, the capital gains tax is likely to rise going forward. Buy-to-let investors who hold their properties individually are now expected to pay more in capital gains tax going forward. We know there's already increasing pressure on property market in general. Will this see buy-to-let investors sell up and take advantage of the exemption while they can? Who knows, but it does clearly make quite a difference there. So I kind of predict that this year we might see a few more motivated sellers in the property market due to that, which you could argue is going to put further pressure on the housing market. So if you are sitting on, for example, a large gain of shares, it could be worth considering things like a bed and ISA, where you utilise your exemption for the year and then repurchase the assets within an ISA. And it's worth maybe exploring that further. So next up is dividends. So the tax-free allowance on dividends is to be cut from £2,000 to £1,000 next year and £500 from April 2024. This actually means, if you look at the maths, a portfolio of just 20 grand, which is just the ISA allowance, if that yielded 5%, that means outside of the ISA, you'd basically hit the dividend allowance from April next year. From the year after, again, assuming a 5% yield, you'd hit that with just £10,000. So these aren't big figures to get potentially additional tax here. So what can you take from it? Well, it just means that utilising things like ISAs, pensions, all the kind of the good stuff from good financial planning is going to become increasingly more important going forward. There's also an argument that, from the dividend side, it could lead some company directors to sort of reassess the tax benefit of running their own businesses, because dividends are getting less attractive as far as extracting profits. And that's obviously a bit of a strange one, considering the government is driving to try and boost GDP. Okay, so the next one is income tax, and the big headline from this one. So the big headline grammar with income tax is that the high rate of 45p in income tax is now going to have been dropped. And this is basically the point where additional rate kicks in, which is at 45%. And this becomes payable now, instead of at 150,000 at the current rates, from 125,000 to 140 from April 2023. And look, let's be honest, I think that's fair enough. Look, these are tough times, and a little bit paid more by those who have earnings at that level is fair enough. All right, so let's chat pensions, and I'll level with you. This was the one that I was probably most wary about as far as big changes. Mainly just as pension taxation rules are a nightmare at the best of times. And any tweaks would have probably resulted from my side quite a few hours in amending some strategies. The only saving grace I thought going in is that it's really hard for governments to change this in such a relatively short period of time. And then even if they'd gone ahead with the rumour and cut pension tax relief, they've then got to figure out how you're going to change things like salary sacrifice arrangements. And it could have a massive impact on defined benefit accrual with the likes of NHS pensions. And that's already quite a hot topic anyway. Yeah, they steered clear of that, and I am thankful, to be honest. So there are no changes announced to pension tax relief. However, the reduction on the threshold for additional rate to 125,140 will see more higher earners benefit at 45% on pension savings, because they're potentially then going to be dragged into that tax band. But the big one they confirmed is that the triple lock on the state pensions would be maintained, and that actually guarantees a 10.1% CPI-based increase for next April, along with the same increases to the level of pension credit. There was weirdly no mention to an extension on the freeze to the lifetime allowance, which I thought was going to come through. So as far as I'm aware, and we're aware, this is still due to increase from 1,073,100 from April 2026. There are also little bits like from April 2025, electric cars will no longer be exempt from vehicle excise duty, and stamp duty cuts will stay in place until March 2025. Okay, so what do I think? Well, look, to be honest, considering the rhetoric going in was everything's going to be tax low, high earners and investors are going to bear quite a bit of the brunt in the next year or so. We're all going to start to feel the pain because of that physical drag, the fact they're not going to increase the bands. Buy-to-let's another reason to be cautious about going into that. But just don't underestimate the impact of the freezes on your pocket. Trust me, it may not sound like a big tax hike, them freezing the rates, but it is. Okay, I was sort of watching this back, and I thought, if I'm being honest, I was a little bit on the fence with my feedback. So I thought I would just tell you honestly, basically having now had a little bit more time to digest it. My kind of overview is that, I don't know, I personally think that we've gone a bit too far. If we think the fact that Liz Truss effectively got sacked because of the bond market, my concern is that we've gone the other way, trying to appease the financial markets effectively. The reason why I think that's a problem is because if you look at the wider picture, we've got, for example, consumer sentiment is absolutely in the floor. You can see that from the JP Morgan data, and also you can sort of feel it. We've got PMI index, which is our basically purchasing managers index, which gives us a good idea of when we're in a recession. That's below 50. We know energy bills have been capped somewhat, but are already really high. We've got bank interest rates rising, which is going to cause more pain for a lot of people with mortgages. Nobody needs telling that we're in a challenging time. When we add to that we're now getting squeezed in addition with additional taxation, My concern effectively is that, well, is this not going to make it even more difficult for people to have the disposable income to ultimately invest in the economy, to do things to, spur on spending and get us out of this mess, instead of it effectively being austerity 2.0, where we just elongate the issues, we make it harder and harder for people to do the things they need to do to get the economy going. But yeah, that's kind of my thoughts now. But here's a slightly more nicer sort of personal finance summary. Go, go, go. Look, I'm always really wary that it's really useful to know these things and stay on top of it, and let's be honest, it's why you clicked on the video. But what hasn't changed is what is important from a personal finance perspective. We know that we can't control when the government inevitably tinkers with the rules. We just have to, in my view, be stoic to the fact that while there are governments, they're going to need to finance things. And because of that, they are always going to adapt and change some things. And I know it's really easy nowadays with the never-ending cycle of negativity in the news, politics, crisis to get lost in. And also, I really appreciate some people really are struggling out there. But in my view, individuals, we can only really focus on what we can control, which is doing all the good things when facing tough times, making sure your emergency fund is good, protecting yourself against disaster, and just keeping a keen eye on your spending. Anyway, next video, I'm going to be telling you how can you potentially retire in 10 years with £0 in the bank, which in this environment is impressive. Anyway, see you next time.